And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA Corporate and Investment Banking, turning intent into execution. That's how ABSA are invested in Africa's energy future. 9 minutes after 6. Good evening. Welcome to the program. I'm Stephen Grootes. Quite a lot of corporate activity around today. Big results. I mean, really stellar results, it seems, from Standard Bank. We'll speak to their CEO, Sim Tshabalala, in just a moment. Also, bizarre things happening on the JSE. I mean, yesterday, Grindrod were down 11%. Today, they're up 11%. And I mean, the real reason for that is because there was an overreaction yesterday. I mean, that surely was the reason, and that was because their earnings were down slightly. So very strange to see things like that happen. Also today, the Minister of Transport, Barbara Creecy, talking about Cape Town Port. Big problems there. Deciduous fruit producers weren't able to export their goods in last year's summer because of the wind. The big changes happening behind the scenes there. You'll hear from the Minister in a couple of moments. We'll also speak to Timothy Walker, the senior researcher on maritime security at the Institute for Security Studies. Does appear that a lot more oil is getting through the Strait of Hormuz than we actually thought. I think that's an important story. And then also the middle class. So many people talk about the middle class. Spending will get us out of this problem. Kranti Pai disagrees. He's the economist and strategist at Inani Strategies. I think that's going to be an important conversation. We'll speak to him before 7 o'clock. Good to hear from you this evening. 011 883 0702 021 446 0567 and a voice notes on 072 702 1702.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Standard Bank reporting record headline earnings, over 26 billion rand in the first half of the year, 10% higher than the same period last year. The South African division doing very well. The bank also investing heavily in AI. So is everyone else. But I think in banking, it really is going to tell how you get that investment right or if you don't. Sim Tshabalala is the Group CEO at Standard Bank. Sim, good evening. Thanks so much for the time tonight. A very strong period with you. You must be quite pleased with it. Your gross loans and advances to customers in South Africa grew by 5%. Are you still seeing quite strong demand for credit, or are you maybe taking market share from some other people?
Good evening, Stephen. Yes, that 5% growth in South Africa is actually a tale of two cities. The retail part of the business, as you saw in private sector credit extension, household credit extension is slower, whereas in the top end of the market with corporates, it's significantly faster. But that resulted, as you saw there, in net interest income being up by 7%. There is activity, if I may just make that point, and that activity is centered around energy, logistics, the power sector, renewables, broadly infrastructure, and all the businesses that support that activity.
Your credit impairment charges were down 12%, and you've obviously been able to cut down on your bad debts. How did you go about doing that? I mean, you obviously want to make sure people pay you back what you lend them. At the same time, you know that you have to lend to actually make money out of the practice. How were you able to cut down your impairment charges quite significantly?
Even Standard Bank has a tradition over the last few cycles of staying consistent in its risk acceptance criteria and not shifting them back and forth. Put differently, even during COVID, we stood by our clients. And so the result of all of that, as interest rates declined and as inflation declined, we saw early arrears reducing. So the period where people failed to meet their obligations in the period 1 day to 90 days. And then our non-performing loans have also started to decline, which bespeaks a healthier balance sheet and customers more confident in meeting their obligations. I mean, just one interesting statistic, in the home loans business, your credit loss ratio was 67 basis points last year. This half, it was 55. And that trend is similar in vehicle and asset finance, in the card business, and in other unsecured loans. It's a healthier customer, even with all the challenges from the Middle East.
I mean, it's slightly surprising in a way that it's a healthier customer, but maybe people have had a chance, just a brief stab to catch their breath a little bit, or finally people are beginning to plan a little better. Financial education in South Africa has exploded over the last 30 years.
It's a combination of all of the above, Stephen. Stronger balance sheets by clients, people maintaining and keeping their jobs. People are now through the first and second cycle of the credit cycle, better experience, more confident in managing their financial affairs. Absolutely.
You say you're investing quite heavily in AI, and you're obviously spending quite a lot of money there. We all know what can happen if an IT problem affects a payment system for a bank of your size. What impact is AI having on your group at the moment? Are you already feeling an impact in some way?
Yes, we are. And I can make it personal. I use Claude and as well as Perplexity to deal with emails, write speeches, work with my team on presentations, do research, prepare briefs, and so forth. And it's made me significantly more productive than otherwise. I'm one of 39,000 staff who are on these Gen AI, Claude, Perplexity, and so forth. It is calculated at a higher level to improve customer experience. So we've got use cases that are specific towards helping relationship managers, call centers, and so forth. Secondly, to improve efficiency, reduce the cost of product and service delivery. And then thirdly, improve our risk management. We use it in risk management as well. To put it differently, Stephen, it's a general purpose technology. It's like the steam engine, water, the computer. If you don't do it, you're going to be left behind.
Do you think it might, in the next couple of years, lead to you using fewer workers? You won't need as many people?
No. I believe in the Jevons paradox, that as you put these technologies in place, you're going to require more human capital. Think about ATMs in the 1980s. Everybody thought that there'd be a diminution of tellers. Well, there was an increase globally of the use of tellers. Or think about the horse cart and the car. The same skills necessary to build the carriage are the same ones as you need to build the interior of a car. The same concept. So we of the view that yes, there will be massive changes, but there will be a greater need for humans.
Mm. Over the last sort of year or so, Sim, you've lost some of your top talent to. I mean, they all seem to have gone to the same place. I don't know if they all had a lot of red in their wardrobe they wanted to wear or something. It does look like that is over, but that must have been quite irritating to see so much top talent leaving like that.
Stephen, it's never pleasing to lose people that you work closely with, and it's also never pleasing to lose talent that you've invested in. But we take a similar view to Goldman Sachs, that it's important for you to retain good relations with people that leave because they're alumni. They may be competitors, but they partner you in industry, in global issues, in risk issues, and so forth. And you hope that over time, the situation in the country, the competitive situation improves. It's good for your clients, and you then also improve. So yes, it's an annoyance. I mean, I wouldn't lie and lie to you about that. But it's also good for competition. It's good for the country.
Going forward, you seem quite confident that interest rates in South Africa will drop by a full percentage point over the next year. I mean, inflation is quite high now. Where's that confidence coming from?
It's based on, firstly, inflation expectations and the modeling, Stephen, and the work that the authorities are doing to manage inflation expectations.
Sim Tshabalala, really do appreciate the time. Thank you very much indeed. The Group CEO at Standard Bank, 18 minutes after 6.
702. Stephen is on X.
At Stephen Grootes.
The Transport Minister, Barbara Creecy, saying she's now implementing a new recovery plan at the Port of Cape Town. You'll remember fruit producers lost a fortune in the last export season. One of the main reasons was very strong winds, which made it impossible for ships to be loaded and unloaded. The Minister of Transport is Barbara Creecy, and I'm pleased to tell you she's on the line for you now. Minister, good evening, and thank you very much for your time. This port exports around 80% of our deciduous fruit. It has to do it all during one particular season, so there's a time crunch in it. How are you going to make sure that what we saw during the last big summer export season doesn't happen again?
Good evening, Stephen, and thank you for the opportunity. Well, first of all, we want to change the nature of the war rooms that we're running. Up to now, it's primarily been Transnet that's been sitting in the war room. In the consultation we had with industry on Tuesday, participants were saying that if we really want to increase efficiencies, we need to bring in the whole value chain. So from September, we'll be sitting together with agents. Those are freight forwarding agents that would be responsible for moving product from farms right through to onto the dock and the vessel. We also need to bring in the vessel owners. And the reason for this is that, as you correctly said, last season we had 32 days of wind above 100 kilometers an hour between November and the end of December, which basically meant that almost every second day was a no-work day, because we can't load and unload ships once the wind speeds go over 90 kilometers an hour. So what it means is we've got to be super organized. We've got to ensure that all the produce is in back of port facilities plugged in to cold storage. We have to make sure that when our meteorologists tell us that we're going to have a break in the wind, we are ready to move product onto the dock. And of course, we have to make sure that the ship hasn't got tired of waiting and gone off to Gqeberha, and it's ready to receive the product on time. From the Transnet side, we have spent a lot of money, 2.5 billion, over the last 2 years, recapitalizing equipment so that we have equipment that can withstand stronger wind speeds. By the end of this year, we will begin to bring in the first of our new ship-to-shore cranes that can work in wind speeds of up to 90 kilometers an hour and can also be operated remotely, so that you don't have operators on dangerous pieces of equipment at high wind speed. We're also bumping up our shift system. We're postponing all leave out of the November-December period for the city of Cape Town, and we will also bring in additional crews from Durban and also Gqeberha. When the wind is high, no one will work, but when it drops, whether it's 2 o'clock in the morning, 4 o'clock in the morning, it's going to be all hands on deck so that we can load up the ships fast.
Okay, so I mean, you're basically getting as organized as you can, and when you can, the ships will load and unload and do their thing. I mean, in a perfect world, we would have a really good, really cheap railway line that would be able to take this fruit very quickly and cheaply to another port that wouldn't be so exposed to the wind. That would cost a lot more money, but the wind's not going to go away from Cape Town, I'm afraid, Minister.
No, it's not. And part of what we discussed with the agents on Tuesday is that there is fruit that is coming from the Northern Cape and from Limpopo. That fruit, if producers know in advance to take that fruit to Gqeberha instead of Cape Town, cost is much of a muchness. So we are going to proactively direct certain commodities from different parts of the country directly to the port of Gqeberha, so that if we have very hectic wind speeds in that very tight time frame, particularly the couple of weeks leading up to Christmas, because you would understand the Northern Hemisphere wants our deciduous fruit on the Christmas tables, then we would have a cushion of availability. But as you correctly say, wind is a fact of life in summer in Cape Town. It's always been there. It's just with climate change, it's obviously the speeds are greater than they were previously. And that's why we've been buying all of this new equipment that can work in speeds up to 90 kilometers an hour.
Minister, I mean, there's a bigger sort of policy that we've seen. I mean, you're talking about, more private operators. That's already happening at Pier 2 in Durban. Transnet is doing the same at the Cape Town multi-purpose terminal. It's not the biggest terminal, but it's still important. The private sector is playing a much bigger role in our economy than ever before. Now, quite a bit of it comes at your portfolio. Think of privately owned trains running on government-owned or state-owned railways, for example. At what point does this process stop? I mean, you not just you, not you alone, but it's going against years of ANC policy in government, and it's happening very quickly.
Look, interestingly, Stephen, there have always been private terminal operators in our country. Way back since the 1900s, there have been private terminal operators. What we've never had is private train operators. So that is new policy, which we've agreed on, and I think that this policy is widely consulted and widely accepted, because what I think we all understand is that we have to protect existing jobs. We can only protect existing jobs if we get product out to international destinations. We can't have the whole of the Northern Cape sitting with tons and tons of iron ore that we can't export, because it's going to lead to retrenchments. We have to be able to get our coal out. If we don't want that coal going out of the port of Maputo, then we have to be prepared to allow private terminal operator at Richards Bay, and we have to be prepared to allow private rail operators that will increase the amount of mineral products we are able to move on the Transnet system by over 24 million tons a year.
Minister, thank you very much indeed for your time. I really do appreciate it. Barbara Creecy is the Minister of Transport on The Money Show.
The Money Show.
The Markets.
Rudy van der Merwes, Portfolio Manager at AdviceWorks. Rudy, good evening. Obviously, Standard Bank, the big story of the day. Really, really strong results from them. And it seems to be from most of their divisions. Just lots of things pointed in the right direction.
Evening, Stephen. Yeah, on the look of it, it does seem like a good set of results, and I think return on equities at record levels. So it does seem to be doing very well. I think the returns are actually being concentrated or coming from two big areas. One is impairments are down very materially, which does obviously speak to good credit management, by the bank, which is obviously something one expects of the top end banks, but it is sort of on the sort of fortuitous side of the range there just at the moment, and over time one could expect some of that to dissipate. And then CRB is doing phenomenally well. So that was up 15%, and that's the bulk of the revenue actually now comes from CRB. And I think that's the one potential sort of weakness one could point out. CRB is now 55% of revenues, and that grew by 15%. So that's the dominant generator of revenue. But the retail bank is sort of slowly being quite hollowed out. So the returns from that were down about 1%, and that now only makes up about 18% of headline earnings. Years gone by, that was 50% or more of headline earnings, and I think over time competitors have carved out quite a healthy living for themselves out of Standard Bank's retail division. On the top end, we've seen us probably in an Investec and Discovery taking a massive market share. On the bottom end, certainly Capitec has contributed towards that. So yeah, I think that portion of the bank is looking vulnerable, and one hopes that the staff losses that they've had doesn't lead to some of the CRB business in due course coming under attack. But from a holistic perspective, the results are good.
Rainbow Chicken, stellar results for them too. They said robust agricultural production, but also higher poultry prices.
Yeah, they, I think, seem to be hit by sort of a perfect storm of positives, actually, just at the moment. Healthy demand for poultry products, which obviously means better pricing for them, and lower commodity prices, so those are the two biggest levers that could possibly be pulled for them. The input costs going down and the sales prices going in the right direction. So that's clearly benefited them very significantly, and very positive trading update talking about headline earnings being up in the region of 140-odd%. So yeah, that's very positive.
And then the gold storm also having a good impact on DRD gold.
Yes, DRD gold benefiting from higher gold prices mainly. Operationally, it's almost identical amount of gold effectively being produced and sold. But the dollar price of gold is up over 50-odd%. So the dollar received price was in the region of $4,200 odd a ounce, which is slightly below where the actual prices are just at the moment. And in rand terms is up 40%, so the rand obviously strengthened slightly, but that's the bulk of where the gains have come from for them. Obviously benefited very significantly from this price move, and one will have to watch very carefully. It is rather marginal mine. Exactly where prices go to from here. Higher prices obviously one would expect translate into better further growth in earnings.
Rudy van der Merwe, thanks so much. Portfolio Manager at AdviceWorks on The Money Show this evening. We will talk about oil prices in a couple of moments, what's happening in the Strait of Hormuz and how people are smuggling massive supertankers through a tiny patch of water. You're The Money Show, just on 6:30.
WhatsApp Stephen
On 072
702
1702.
So, yesterday in Parliament, Buti Manamela, the Higher Education Minister, had to answer questions about what's been happening at NSFAS. And if you look at the National Student Financial Aid Scheme, you look at how people are going through higher education, it is one of the most important things that we do as a society. You're taking people from all parts of the country, all different classes of the country, and you're giving them a chance at being part of the elite. It is just the most important thing, and we spend a huge amount of money on it, and so we should. What I just can never understand is how we always have arguments about the funding of it. Now NSFAS has an administrator. That administrator has 4 advisors. Daily Maverick, who I know I also write for, so take it from whence it comes, because there is a conflict when I say this, has done some extraordinary reporting in the last couple of weeks about how much money these advisors are spending. I mean, it's a massive amount of money, and it doesn't seem to make much sense to me. So I don't get what's really going on at NSFAS. You've got court battles looming with the old board that was disbanded. But surely, if you're going to appoint someone to take over NSFAS as an administrator, you're going to sort out what you're going to pay them and how they're going to do it first, before you appoint them. You don't appoint and settle something like that later. You ever taken a job and been told what you'll be paid later? No, me too. So it really is just a bizarre thing. If you're a student and you're watching this play out, I mean, it could really affect you, could really affect your friends. Your thoughts, please, on 072 702 1702.
702. Stephen is on The Money Show.
6 to 8 p.m.
16 minutes to 7 the time. Well, lots of discussion in the US and elsewhere about the biggest variable that affects you, international oil prices. And you would think, if you look at the prospects for peace in the Middle East, I'm afraid to say they look quite bleak to me. You would think prices would be higher than they are. It does seem China is still playing a role in determining fuel prices. Huge storage capacity, maybe 6 months worth of the oil it used, has allowed it to limit its demand. But the other factor is how much oil is actually flowing through the Strait of Hormuz. Not how much oil people say, how much is actually on the market. Now, normally, in pre-war times, we're looking at 21 million barrels a day. Some estimates say could be as high as 7 or 8 million tons. And you can imagine the politics around this argument as well. Timothy Walker is a senior researcher on maritime security at the Institute for Security Studies. Timothy, good evening. Thanks for your time. So Iran says the Strait of Hormuz is officially closed. They'll attack anyone going through there. They've got a navy. They can do that. They've got mines there too. And yet, it does seem that some oil must be sailing through. How could ship operators be doing this?
Good evening, Stephen. Thanks for having me on the show, and good evening to everyone listening. There are a lot of ship operators, ship owners, and national companies, particularly the UAE, who are prepared to take a risk. The kind of operation of a shuttle system, as it were, of smaller vessels taking on the oil from the sources in the Gulf, and then by turning off their transponders, by hugging quite close to the coast, the south coast of the south part of the Strait of Hormuz, close to the Omani shore, trying to rely somewhat on U.S. protection, such that it is. The Iranians do seem able to operate a substantial number of drones and missiles which do attack these vessels. They then, when they get outside of the Strait of Hormuz, transfer this oil onto larger vessels. The larger vessels, which we would typically see going in and out, which would be carrying most of this, 20 million barrels per day, they're far too valuable for the owners and companies to risk being attacked or disrupted. So you're seeing a lot of smaller vessels utilizing the route, and those are the vessels which we're increasingly seeing being attacked as well. The UAE national company has reported 15 of its vessels have been attacked by Iran over the last couple of weeks. So there's a lot of risk involved, but the profits and indeed the potential delivery of oil can be quite substantial if these ships get through, but there's a lot of uncertainty around it still.
I mean, there seems to be a big oil slick there as well, which is spreading, and that must be the result of some kind of successful attack by Iran.
Yeah, off the south coast of Oman, a ship which was sanctioned called the Caroline Bazingi, unfortunately flagged by Cameroon, falsely flagged. The Cameroonian government realized that its shipping registry was being exploited, and it kicked the vessel out. Because it was loading Russian oil and subject to sanctions from the United States and the European Union, its insurance is effectively rendered null. And its insurance, such as it might have only existed really on paper, maybe a Russian insurance company saying that if anything happens, we'll cover the cost. Now, this has happened. Nobody has actually claimed responsibility for this attack. But the ship has been drifting for several weeks. There is a salvage company currently trying to do something about it, but the costs could be astronomical. This is actually in a marine protected area, quite important for Oman sea life. So the risk of this actually getting worse, the costs it could have, and who bears that cost, are substantial. And this is, like I say, in Oman, this is actually south of the Strait of Hormuz. But the risk of another vessel like this being attacked, even one of those smaller vessels, and even though I say small vessels, they are substantial in terms of the hundreds of thousands of barrels of oil they can carry. If something like that were to happen, the risk, the cost, it could be astronomical. And insurance companies are obviously naturally very jittery about this. They are pricing the risk of insuring ships who are looking to be involved in the vicinity of the area of the Strait of Hormuz upwards, almost usually about 1% of the value of the vessel would be extra war risk and premium. We're looking at 5% of the cost now as well. So a typical vessel costs around $100 million. So the costs go up and up, but the pool of money which is then available to do something about a potential accident is not substantial enough if the number of vessels increases and the risks remain the same. And that's the problem. The probability of risk or harm caused by Iran is not actually changing very much, despite what the US says about being in control or being able to exert some kind of protection.
I mean, this is Iran's big lever, and surely it has to use it. It can't tolerate this for much longer, and it must also be quite expensive to use a whole lot of smaller vessels. People used to use one for a reason.
Yes, exactly. The economies of scale for a large shipping vessel and the huge amount of value you can derive from a safe delivery of that cargo always made it much more profitable. The shift, we are seeing a massive shift in the oil market, the maritime dimension of it, obviously with the number of vessels, the type of vessels being carried. We're also seeing an enormous shift now potentially in terms of the direction of the investment of new oil pipelines, trying to get oil out of those exporting countries, but as far away or as removed as possible from the Strait of Hormuz. That has always been talked of as the choke point, and Iran has choked it, and the United States has shown that despite all its best war gaming and tactical planning and decades of for instance officers going through training thing, what would you do in this kind of scenario, ships being deployed to the area, they haven't been able to do something about it. So Iran is in a great position for itself in terms of survival to continue to exert this kind of control, and it doesn't even often have to attack vessels. Just the threat alone is still enough to deter people from returning to normal shipping levels. The Iranian regime itself, as we saw earlier this year, was in a very precarious position, and I don't think it's necessarily been in a stronger position. Its position relative to the United States in terms of diplomacy and what it can exact in terms of negotiations is very strong. But maybe the regime itself, if the US blockade continues, if oil prices continue to be low as well, will continue to be in a precarious position. So it's going to, as you say, leverage what is within its control, and it's doing that to its maximum possible extent. Unfortunately, to the cost of us all. And you mentioned just briefly in the beginning about China. it does seem one of the big reasons oil prices are so low is China has been lowering its imports and drawing on its stocks, and upwards of estimated sort of 1.5 billion barrels of oil the Chinese have been effectively, putting into the oil bank or the oil tank, as it were, just for this kind of scenario. So if China decides one day to stop doing that and maybe start competing for oil prices, competing for oil on the market with countries like South Africa or other vulnerable countries who need oil prices to be low, then you could see a massive oil price increase. But that's not really in anybody's interest as well. So, like I say, the role China is playing is absolutely fascinating at the moment, and it's worth continuing to look at how Asia in particular is looking at drawing on stocks and trying to lower its imports.
Timothy Walker, thank you so much. Really do appreciate it. Senior researcher on maritime security at the Institute for Security Studies. And just to build on his point about China now would appear, just through sheer capacity, not through producing oil, but just through sheer storage capacity, have the power to really change oil prices. And when you consider the rivalry between the US and China, that is an immense lever indeed. 7 minutes to 7.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, turning intent into execution. That's how Absa are invested in Africa's energy future.
An important analysis this week about the middle class and how we understand it. And perhaps looking at some of the myths of it. It comes from the economist, Kanti Pai. He suggests that the view that we have that our middle classes will grow, that will lead to economic growth because they'll spend more and that will lead to more demand, etc., is incorrect. Kanti Pai is the economist and strategist at Inani Strategies. Kanti, good evening. So the idea is that people in the middle classes will have more money to spend. That'll lead to greater prosperity. What do you believe in reality is actually happening?
Good evening, Stephen. That, unfortunately, is not exactly what is happening. And I guess we have to start in South Africa by understanding, of course, that our problem of income inequality, because you have to realize when we talk about the middle, right, the middle class, we tend to think about people who are in the middle income. And Steve, I think, Stephen, if we think about it, especially most of us who can actually sort of imagine that statistics, right, we sort of look at that bell curve. Most of us should be earning the lower incomes, most of us, and there'll be a lot of people on the other side who have all of those high incomes, and then we cluster a lot of them in the middle. So that bell that you see. Unfortunately, because actually that bell doesn't look quite the same in South Africa, where you actually see that, there's a lot of people who are mostly, earning the lower income. And so the middle actually appears quite skewed because it appears at the lower incomes around, those 5,400. So the middle income is not so much what we think it should be, where it's these people who are in the middle who are earning between, the poorly paid and the highly paid. It's actually, the middle actually appears in the poorly paid because so many people are in that level of income.
So a lot's going on here, and we know it's in the nature of our society that most people have families and communities they have to look after. They have to look after people who aren't working. When accidents happen or people need medical care, they have to do that and look after that. It's also about state failure, right? People have private security companies and private schools. Yeah. How big a factor? So, the nature of our society won't change for a long time, unfortunately. But how big a factor is state failure in this?
It's a huge factor, Stephen, and I think this is part of it. And it's a huge factor in two parts. The first part, of course, is that we know that the social weight is important because what it does is that it cushions us, from sort of our low incomes. Because if you've got a reliable transport system, for example, that's affordable, then you know that, you don't have to pay so much. And we know that many people in South Africa actually pay as much as 40%, and some people even more. In terms of what they pay to go to work, to get to work from their low income. We know that a lot of people have to try and move away from, take their kids to schools that are outside of their own region and pay a little bit more because of the fact that they are looking for better schools, and that costs more. And of course, the private health system is not doing so well, and so we try and fix this with going to private doctors rather than for primary health, and then it gets even more complicated when you need the kinds of, secondary and tertiary health attention. Then the second part of that is that it affects, I guess, smaller businesses, because if you think about it, then these people will in time look for, to increase their salaries. And this is some of the things that has happened is that as then the cost of living rises because the state is not meeting its demands, then we will start to actually, agitate in terms of the employment. And then we have this burden that's moving to smaller business. So then we are not able to create the employment that we need, because most businesses are struggling to afford, good waged earners, or, the low income age earner, because they are constantly looking for increases. And so we're struggling to balance this, and you start to see that in inflation. So this becomes then a cycle that is quite devastating to the economy. So we really need to do something about that first round, which is, the social wage, where we actually have the government paying for the basic services, and then for the rest of us, the other things we can take care of ourselves.
I mean, and if you consider that middle classes are also supposed to provide the vast majority of personal tax, and yet, from the numbers you quote, I mean, most people can't be expected to do that.
No, we can't, and and I think this is part of the thing. And many people, usually say that there's only a few people who pay tax, and income tax obviously is not paid by a lot of people because they earn so little in the middle class. But certainly they do pay VAT, and whereas a lot of people will say yes, but we've got a lot of VAT exempt items. Yes, that's quite fine, but that's usually on the foodstuffs. But generally on the kinds of things that actually we need. For some, for daily living, and certainly for actually, remember the middle class is also supposed to have some discretionary income that allows us to propel, to buy TVs, to buy all of this stuff that actually creates jobs, that drives manufacturing, that drives expenditure and drives growing economies, and also, the capacity for people to do better, because the better jobs tend to obviously appear in the manufacturing sector, in the secondary and the tertiary sectors, not so much in the primary sectors. And we struggle there because not all of us are going to depend on just food. And so as we move people up that sort of value chain, that's when you start to see a thriving society. And unfortunately for us, that is not what is happening at the moment because of the troubles that we've just defined.
Grootes Pai, thank you. Really do appreciate that. Very interesting thoughts. The economist and strategist at Inani Securities. You're at The Money Show, 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA Corporate and Investment Banking, turning intent into execution. That's how ABSA are invested in Africa's energy future. Well, lots to come in the next little while. We will speak to Siphumelele Zondi, your tech expert. He's talking about Claude, not his mate, Claude AI, saying that they're going to watermark what they put out. I must say the issue of what's AI and what's real or from a human is just becoming one of the sort of defining questions of our time. It's changed social media. AI has changed the web, the politics and the economics of the web. I do wonder, though, over time, if any of these models are is any better than the other. Quite a few people I know talk about Claude. Plenty of people I know are using ChatGPT. Do you have one in particular that you think is better than the others? Does it depend on what you're actually doing? Surely it must do. And the power of these things can really be incredible. Obviously different from industry to industry. I was interested to hear Sim Tshabalala, the CEO at Standard Bank, saying he uses AI to help him write speeches and reports and things. And I'm sure many, many people are doing that with reports. Here's what I don't get, and it's a bit like AI music. Okay, you can produce as much AI-generated music as you like, but who's going to listen to this stuff? It's the same with reports. Is it going to be read by an AI that spits out a summary, in which case, why not just get them to talk to each other? The AIs, I mean. Where do you go from there? Then what are the humans actually in charge of? So, I mean, the way in which we produce things, I think, is going to change. And as Sim Tshabalala pointed out, he thinks that more people will be employed, and his bank will actually employ more people as a result of AI, not fewer. I thought that was very interesting. And I suspect perhaps that might be right. I tend to be quite optimistic about these things, and I do think that that is likely. But your favorite AI model and why? We'll speak to Jeremy Lang, the Managing Director at Business Partners. What happens with small firms when financial problems come and how they sometimes make that mistake worse? And then in Investment School this evening, Wayne McCurry. Yes, the Wayne McCurry back on your radio, and Grant Nader from Benguela. We will talk about the difference between quality investing and value investing. Why is it important to have a mixture of both? What does one do? What does the other do? I think that could be quite interesting. Good to hear from you. 011 883 0702 021 446 0567 072 702 1702.
The Money Show.
with Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
And DSTV channel 856. The Money Show. Tech Thursday.
Well, the AI model Claude AI saying they'll now include a watermark in everything it produces. That would be a game changer. You can imagine being an author, a publisher, in academia. Now your work has this watermark. Siphumelele Zondi is our tech expert. How's it, Siphumelele? I mean, people have been talking about this idea for a while, and I can understand how a watermark would work in an image, but how would it work in this case?
Hello, Stephen, and yes, so it's not a visible watermark that you're going to see when you are using AI to generate, let's say, speeches, content, essays for you. This watermark is going to be embedded in the words and using metadata, and so it's only machines that are essentially trained to detect the watermark that are going to see that someone actually, or the person or the individual or the student used AI to produce the work for them and they didn't do it themselves. So it's going to be embedded in the text itself as opposed to it being something that's going to be visible that can be seen with a naked eye.
So would you be able to copy and paste it and get around it like that? Or would a computer still know that this is actually the result of AI because it's been done in another way?
So listen, people always figure out ways of trying to teach these things. And there are always, as soon as there's a way of detecting something, then someone creates an AI that's going to try and bypass that. But yes, initially you are going to, you can copy and paste, but even when it's copied and pasted, it's still going to figure out that it was written by AI in the way that it's going to be developed. But as I say, that there's always someone who's trying to give people another method, another tool that's going to try and cheat it. But initially, yes, even if you copy and paste, it's going to be detected.
But it would be still invisible, right? And I mean, this is the thing. No one wants to read something that is sort of obscured by some kind of watermark in any kind of way.
Well, definitely invisible. And it also, with AI, depends on what you're using AI for. Because what you find is that there are people who use AI to bounce off ideas, but they're not going to be producing AI in a public space as the work that they did for themselves. Yes, there have been situations like I came across a video of a Canadian politician who read AI work, and then to the point that they even read when AI was telling them that a better way or a different way of doing something or saying something would be a particular method. But in a case where you're using AI to bounce off ideas, then maybe it's okay. So no, it's not going to be visible. It's not going to be detected. You're not going to see with a naked eye that no, this is AI. And if you're using it for yourself, then it shouldn't be a problem because you're using it for your own personal use, and not to say that you produce the text yourself.
Are we going to see the other AI models and the other people who make it, so Gemini or ChatGPT, are they going to do the same thing?
They haven't said whether they will right now. So in all likeliness, they're not starting right now. But this could be starting a trend because there has been issues and very many court cases, especially in Europe, for example, where there have been court cases where there's worry that AI is sort of generating work that's created by humans or training AI with work that's been created by humans without the AI acknowledging the original creators of the work. So because of those court cases, so AI companies need to figure out ways of how they are trying to be transparent and acknowledging that this is something that came from elsewhere. So in all likeliness, this is starting a trend, and in all likeliness, they are going to also try and adopt either this method or other similar methods.
Okay, I mean, to look at those court cases in other ways, so authors take the AI model to court. They say you've learnt from my work and you haven't given me proper credit for that. Would this help them? Because over the longer term, if everything's watermarked, you would know where it comes from. I don't know if the watermark would then be able to tell you like if you go into Gemini now, so you do a Google search, it'll tell you where the responses come from. That might work in the same way to see the original author of content that's now being presented to you.
Well, it might also lead people to go and research or go to the original author. But the issue as well has been on the money, right? Because if you're training AI without an agreement, yes, it might lead some people back to the original author of the work. I'm not even sure if people click on the link to the original author on Google AI when they're getting those AI responses. I would think they don't. But also, who then makes the money? Because sometimes you find that things are hidden behind paywalls. Do people then go back and do they pay? Because the AI itself did not pay the originators of the concepts before it trained its models on the AI. So it might be a way that they are trying to say, listen, we are safeguarding ourselves. But it also doesn't solve the conundrum of the fact that the originators of this content are losing money because AI models are being trained on the work that they would have created.
I mean, some publishing firms are looking for AI engineers as well. I mean, do we know what they're going to use them for?
And that's actually quite interesting because you worry when you realize that publishing firms are looking for AI engineers because they've always been dead set on saying that, listen, we're looking for human authors, et cetera, and we want work that's created by humans. But for now, they are using AI engineers not in the authors of the text, but so they say it's to improve internal business operations, manage data, for optimization online, for metadata tagging. So their work and the work of the authors that they publish is easily found online in order for then people to go and purchase the work that would have been authored by the people that they have deals with. So far, it seems to be for business purposes and marketing purposes, and it doesn't seem to be to author the work for now, at least.
I mean, I'm one of those people, when I read something, whether it's a letter or whatever, I go to the bottom of it, the last thing, to see who wrote it, right? I want to know who that person is and what their position is. And I'm sure I'm not the only person like that, because something is only as important as the person who said it. It's a sad fact, but it's true. The context of who wrote it is so important. That must be the case as to whether it was AI. I mean, you can read something and be shocked and horrified, and if it's written by a computer, you know it's a hallucination.
And also if a computer does not credit to or because sometimes with AI that it would not give you credit of who wrote it. And also, as you mentioned, there have been hallucinations as well. And this is where this can also help. So you know that it's a real human. It didn't hallucinate and make up stuff and created authors that don't even exist, because it's been found at times to have created authors that don't exist. So it has citations that you cannot find anywhere else. Think about AI policy, for example, that had to be pulled back by the government, where it was found that it hallucinated, and there were authors and there were citations that didn't exist that were found there. So this is where it can also help to know that it's AI that wrote the work, and then because there is this watermark that's found in the wording, and it also then shows where the work actually came from.
Siphumelele Zondi, thank you. Do appreciate that. Our tech expert. So much going on around AI as always, but I mean the actual productive use of it. I have to say, in my job where, credibility is everything and everything has to be true and it's all about facts, I tend to sort of steer away from it. I don't mean that I don't use it. When I'm searching for something, or what I really enjoy and find incredibly powerful is, instead of just Google search, I can say, what is that, or how many, or whatever, and I'll get a cogent answer, and I really appreciate that. And it does make life a lot quicker and easier, and I think that's really important. But for me, otherwise, not as much as everybody says, but it may just be me being old-fashioned and a journalist. Same thing. 18 minutes after 7.
The Money Show. Small Business Focus.
Small Business Focus is brought to you by Capitec. Start up or scale up with Capitec, the business bank for everyone. Well, you can imagine with many small businesses at the moment, one of the things that happens is you run into a small cash flow problem and you need to get some money from somewhere. But if you make the wrong decision, if you get the money, the funding from the wrong place, it can leave you with really quite a big debt hangover, can hang around for quite a long time. Jeremy Lang is the Managing Director at Business Partners. Good to chat again, Jeremy. Sometimes people are desperate. You're looking for money. You can keep the show on the road, but only if you get a bit more money. And one of the problems that can happen is if you use the wrong type of funding for the problem. What happens then?
Good evening, and also to your listeners. Yes, indeed, and certainly very relevant at the moment when times are a bit tough. The economy is being impacted by macroeconomic conditions and events. And it's really, really important that when there is a cash flow need, one really unpacks why the need exists and then go into the market and not just find funding. I know the color of notes are the same everywhere, but the type of funding that you utilize, the structures that you utilize, the terms and conditions that you utilize may differ from funder to funder.
Okay, so you need to be quite careful about what the money is for. You need to make sure that you borrow the right money, the right amount from the right person.
Yes, and to bring into the conversation is funding shouldn't fix underlying issues, because then you are only funding a problem and not resolving the underlying issue, which may result in you sitting with the same problem in a few months' time. But more technically correct is that shorter-term funding should be used for shorter-term solutions and longer-term funding for longer-term solutions. And as you mentioned earlier, if you don't get that structure right, you can sit with, as you coined it so nicely, a hangover of debt for the long term when you actually didn't need it.
Okay, so, I mean, there are things that funding can do. I mean, it can give you a breathing room, but it can't keep you alive forever. You actually need to change whatever's caused the problem, whatever the underlying issue is, the operational issue, whatever it is. That's what you need to change, and you can't mess around with that. You have to change it.
Yes, I mean, funding should ideally be used to create more value, okay, and not to cover losses or overheads. Yes, of course, there is that from time to time. The world is in a tough place. There's pressure on costs. There's margin squeeze. But ideally, debt should not be used to cover shortfalls resulting from problems that should not exist in your business. So it's really important that you, before you even go and look for funding, that even though it may solve problems, the underlying problems are indeed solved first before you get that funding need, because the funder that you approach is going to do the exact same exercise, by the way, and it would put you in a very good position with them to say up front, I've identified this problem, this is what the funding is going to be used for, this is the impact in the medium to long term, and the business will remain sustainable and viable.
I mean, you've got to be quite honest in your assessment of what's going on and why you're in this position. If you don't do that, if you can't work out where you can become more efficient, well, then there's no point.
Indeed. And if there's just the rush to go and get funding to solve the problem, you could end up paying a higher cost of capital than you should, because there's more risk associated with your business. You could be locked in structures with severe penalties for early exiting. There could be covenants imposed on your business which restricts your ability to run your business. So if you don't get it right, you could lift the escalating cash outflows in your business without creating more value and cash inflow. And then your business starts to go backwards rather than grow and become stronger.
Timing is also important. And when you are in a bit of a cash squeeze, you might put off getting more money for as long as you can because you're so worried about debt. What can happen then?
Yeah, that's a really important point. SMEs do generally, I say that generally, not everyone, wait too long before they approach funders. No funder wants to fund a business that's already in a cash flow strap. So funders appreciate and respect good financial discipline and planning by business owners. They'll value a business owner that can see the funding need 6 or 12 months down the line. And they wait for various reasons. Some information is not readily available. That speaks to financial discipline. Sometimes they're not compliant, up to date with their taxes. Some take a wait and see attitude. And it's generally a cumbersome process, and business owners tend to want to run their business rather than deal with the administration of raising capital. But liquidity planning, capital planning, balance sheet structuring and planning is such a critical part of running the business. It's really important to plan well in advance.
I mean, you've also got to look at sort of how you deal with this problem over the longer term, because if we look at fuel prices, for example, costs are going up and all of that sort of thing. It does mean that you have to be more and more careful. So you need some kind of strategy, because you might need lots of sort of short-term cash over the next couple of years.
Yes, I mean, nobody really knows for sure how long this squeeze on the increase in the fuel prices and the squeeze on margins will last. But it's really important, and we see that in some of the indexes that we run. SME owners are shifting towards survival, stability rather than growth, which is concerning because it constrains investment. If sentiment is down, business confidence is down, good businesses start to become uncertain around whether they should expand and invest. So it's not unusual to see that in tough times, businesses do shy away and reduce their risk appetite and shift more towards stability, survival, and then most importantly, ensuring there's no wasted costs, improving efficiencies, just to unlock some more margin within the product cycles and cash flow cycle. So I'm not surprised to see the feedback coming that is the behavior at the moment. And I do hope that this environment is not sustained into the medium and long term, because SMEs will start to run out of cash reserves, financial muscle, to see them sustainable into the future.
No, sure. I mean, that really, I think, is the concern. Jeremy Lang, thank you. I really appreciate that. The Managing Director at Business Partners on Small Business Focus tonight on The Money Show.
The Money Show.
Investment School.
23 minutes now to 8. So one of the phrases, or two of the phrases rather, that you'll hear all the time in investments are value investing and quality investing. And essentially, I suppose, we'll hear from our experts in a moment, they relate to the differences between companies whose shares you will buy. It's a comment about the type of company, or a way to describe the type of company that you're buying shares in. And as always with investing, I'm sure at some point it's about diversifying and making sure that you have the right blend. Well, it's a great pleasure to welcome back to The Money Show Wayne McCurry, as you know, a man of vast experience in these matters, and Grant Nader is the portfolio manager, Benguela Global Fund Managers. Good evening to you both, and thanks for your time. Wayne, I do need to start with some definitions. So when we talk about quality investing, what kind of companies are we looking at? What makes something quality rather than making it value?
Well, quality is just really, I suppose there are so many definitions, but simplistically, it's normally a big company that's been around for a long time, with management who have expertise in that field and have been there a long time, who pay consistent dividends, who have relatively low volatility in their earnings, strong balance sheet, big interest rate cover. In other words, companies that are quality. They're not carrying large amounts of debt. They don't have massive variations in their earnings. So simplistically, you can say quality will be most big banks. They're just talking South Africa now. Most big banks, most big retailers. And then the antithesis of a non-quality company is a mining company that goes from feast to famine, back to feast again, depending on the commodity cycle. 10 years ago, they were all half bankrupt. Now they're flush with cash. That's I suppose, the real differentiator between a quality and a non-quality company. Of course, the share prices can react differently, but I think that's a reasonably good definition of a quality company.
Okay, then what's a value company? I mean, would it be a mining company going through a bad time, but with strong deposits?
Correct. So a value company will be, it doesn't have to be a new company. The value companies have maybe been around just as long as what the quality companies have, but it's companies that work in a very variable environment and are now at the bottom of the cycle. So as we're speaking about classic case, the commodity companies, I mean, they were riding the crest of the wave in 2008. Literally within 5 years, they're almost bankrupt. Then they ride another crest of the wave, and it carries on on a cyclical basis. So it's a company that has fallen on bad times, either because of the external environment or something that they did wrong internally, and the share becomes a value share. So quality companies can become value shares. They don't stay quality forever. Depending on the circumstances, maybe management took a completely wrong decision. Maybe there were external circumstances that have depressed their earnings or dropped them into a loss or litigation or whatever the case is. So value investors try to identify cheap companies. Now, that's relatively easy to do, but you've got to say cheap companies that will recover and aren't just going to stay cheap forever or even get worse. And that's what's called a value trap. I mean, a company looks cheap, but it just continues to get cheaper because there's no sort of turnaround in the company's fortunes. So ultimately, it boils down to variation of earnings and balance sheet strength, the difference between value and quality.
Grant Nader, would you need to have both types of company in your portfolio?
It depends on your style and your ethos as an investor. I mean, you certainly can have both. There's a place for both. And there's an overlap too. As Wayne said, you can find quality companies offering value, and you can also find quality companies that are maybe overpriced. So you actually need to decide who you are as an investor. Some people want to own quality at any price, and they'll just be a quality investor. But they open up other kinds of risk in that case. And if you can find quality companies at attractive prices rather than maybe cheap, because a good quality company it very seldom gets cheap. It just gets less expensive, or there tends to be a bit of a quality premium around really good quality companies. So on average, you're paying a little bit more for that quality. But yes, Stephen, the short answer is you can certainly have both in your portfolio, and you can blend the two, or you can have two different categories. It all certainly works, and you also can get growth quality as well.
So, Grant, I mean, sometimes if a share is looking relatively cheap, you might think, well, then it must be an opportunity for value. This price will definitely go up. Is that always the case?
No, it's definitely not. I mean, as Wayne alluded to, a value trap. So something that's cheap is not always offering value, and one does need to be careful about that. And something value investors do spend a lot of time on is figuring out what's the catalyst, what's the thing that can change that's going to realize this value. If you think a share's worth 100 and you buy it at 60, that doesn't help you if the share stays at 60 for the next 5 years. You need the share to recover to that intrinsic value that you've determined at 100. And it may be an internal catalyst, a new strategy, a new CEO, something they're doing differently, or a turn in the cycle. So, for example, the commodity cycle that Wayne was talking about, that could turn in your favor and unlock that value. So if you think about our retailers in South Africa at the moment, they're very cheap. They're definitely offering value. But you need that upside improvement in the macro environment or something to see that value realize. So it does involve some doing your homework. You don't want to be caught in value traps. And I think there are a number of those out there as well, especially in a very low growth economy like ours.
Wayne, generally speaking, you get what you pay for as a rule of life, not necessarily investments. Can you pay too much for quality? Can it actually, you would think, well, you can't pay too much for quality if it's a long-term investment, but can you?
Look, if a company remains a quality company, now, of course, companies change over time. Nothing remains quality forever. Nothing remains value forever. Any type of definition, a growth company, a quality company, a value company, there's lots of these different definitions around. But if a quality company remains a quality company and you just buy the share when it's too expensive, then your returns may be subdued, but ultimately you will make money out of it as long as the company remains a quality company. Now, to me, a good example, and I'm not saying the company is not quality, but something has changed. For many, many, many years, you just bought clicks. It doesn't matter what you did. It was quality. It just went up. We all know what's happened to the click share price over the last while. I mean, today it hit another, 1 year low again. So companies can change. I mean, honestly, my experience of investments is there's no one winning style. There's no one winning methodology. You've got to have a very, very diversified portfolio. It's the only thing that actually is a free lunch in investment, is diversification. And then the true key, I suppose, if you can get it right, is to try and differentiate which cycle is in favor or which cycle going into the future is in favor. Because value investors, I mean, very simplistically and a little bit tongue-in-cheek, value investors have 8 terrible years, and then they have 2 absolute stonkers, where it makes up for that 8, and maybe it makes up for the 8 in buckets. And then quality investors or growth investors, have 8 wonderful years and then 2 absolutely shocking, atrocious years. So this is what a cycle is. No one style wins forever. No one style is better than any other style. I've seen masses and masses of comparative performances of different styles. It all depends on your start date, your end date, and how long you're measuring over. You can make anything look the best depending on how you measure it. In other words, lies, damn lies, and statistics. So you've got to be diversified. Personally, I prefer quality shares because I'd rather have 8 good years and 2 bad years. But you've got to have a diversified portfolio. Value investors tend to buy shares 3, 4, 5 years before they actually do turn. And by the time they do turn, they've lost half their clients because their clients are sick of this terrible performance. So value investing is a lot more volatile. But those 2 years when it pays off, you are king.
Grant, that must also mean then that if you're going to be a value investor, you require a lot of patience. You've got to wait these things out, and that's hard to do.
That is 100% correct, Stephen. You don't know where you are in a given cycle and also even in a given company. And they certainly are patient animals. That is in their DNA. They like to be contrarian because often you're saying, I think there's value in this company when the rest of the market is saying, I don't want to touch it. There's nothing here for me. And this business is broken. So that nature of being a contrarian in itself requires patience. And that conviction, you have to have a lot of conviction that you are going to be right and the market is wrong. So there's a lot of the inefficient market sort of assumption that's baked into being a fundamental value investor. And certainly that comes with the need for patience.
Okay, so Grant, quality and value, and we talk about diversification, and one of the important things about that is that as the market cycle plays out, they perform differently. So what could you use each one for? How do they perform differently across a cycle?
So quality is your more consistent performer. You often get there's a term consistent compounders. So some of your best quality companies, they just compound steadily at a healthy rate of return every year for years and years and years. You want to form, in my view, the core of your portfolio out of those quality businesses because they give you that stable, reliable return on your dividend and on your earnings year after year. Yes, prices may go up and down, but your underlying business return, your economics are steadily improving every year. So I would build a core around that to ride you through most cycles and to carry you in good times and bad. And then you could look at something around the edges where you're saying, I think it's time for value. I think resources are going to have their day, or the retailers, or something cyclical, and it's time to dip in that. Or I'm going after pure growth. I think, the next 3-5 years is going to be all about tech. It's all about high growth. I'm going to sacrifice a bit of quality and play there. So I would kind of balance out like that. I would have the majority of my portfolio in those quality sleep at night stocks. And then you can look at where maybe you want to play in some other opportunities that can deliver that extra alpha when their time comes.
You with The Money Show, Investment School on The Money Show. We're speaking to Grant Nader, the portfolio manager at Benguela Global Fund Managers, and Wayne McCurry, who, as you know, has been in this game for a very, I won't say how long, but he's been in the game for a while. We'll continue our conversation about quality investing versus value investing on The Money Show in just a moment. 11 minutes to 8.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, turning intent into execution. That's how Absa are invested in Africa's energy future.
The Money Show.
Investment School.
We're speaking about quality investing versus value investing. Grant Nader is the portfolio manager at Benguela Global Fund Managers. Wayne McCurry, as you know, has a lot of experience in all of this. Wayne, how do you know? So when you're looking at a company and you're trying to work out, is this value or is this quality? What are you looking at? You're obviously looking at quite a few metrics.
Yes, you are. I mean, essentially, you're looking at the current market rating for the share. Value normally would have a very, very low price earnings ratio, or if they are paying dividends, a high dividend yield, and a quality company will have a higher price earnings ratio, normally, 20, 30, 40% above the market average, and a fairly low dividend yield. But then there's a lot of factors which I spoke about earlier on, really. Balance sheet strength, quality of management, expertise in the field, competition in the field. Are they a market leader? Do they dominate this? Are there very high barriers to entry? But essentially, you can boil it all down to a relative share price performance, or a relatively stable share price performance, and a stable earnings profile over time. But there's a myriad of factors that you look at. And certainly after you've been in a market and read a company's, reports every 6 months, and you get to know management and you get to know what the company does, and in other words, nothing comes up and surprises you, or it's very unlikely you're going to get a huge negative supply. Their industry's not under major threat from new developments and new industries coming in. They like quality, a Bidvest. You just know they're well run. It's a good company. They know what they're doing. They've been around forever. They've never made a ill-advised acquisition. They've never bet their farm on anything. They're good allocators of capital. They make the right capital decisions going forward. There's real quality, but quality can change. 25 years ago, Pick and Pay was quality. It's no longer quality. So yes, you've got to keep up to date with companies and how they evolve and how they change and how management reacts to threat and competition and all of this. So the definition quality is always around, but the companies can alter, but they normally alter over long time periods. They don't alter. It's highly unusual to find a quality company that really gets beaten down by the market over a 1 or 2 year period. It's normally a sort of a gradual erosion of quality.
Grant, sort of on that point, if you've made what you think is a quality investment, and now you're wondering if it's wrong. How do you know if your investment thesis isn't holding up? The share price might be going down, but you think nothing fundamental has changed. How do you know what the right thing to do is? Grant Nader? Yeah, we seem to have lost Grant.
Sorry, I seem to have. Sorry, Stephen, I caught you there. I must have been on mute. I mean, that's a great question, because things can change. You need to, with any company, quality, growth, value, whatever you buy, you need to stay abreast of what's happening in that company. Now, often with a quality company, you might have one report where there's a little bit of a wobble. Maybe it's a little disappointing. The share pulls back. And it's not obvious yet that the quality is deteriorating, because they may recover the next reporting period. And you often see that with good businesses. But every now and again, you start to see quarter 2 or results number 2. That same pattern starts to move into a trend, whether it's margin compression, slowing revenue growth, returns are deteriorating, management maybe make a bad acquisition decision, start spending shareholder capital, overextending on a certain investment, or debt, taking on debt. So there's a number of things you need to look out for that could start to indicate, this company's losing its moat, or its management's starting to, not respect shareholder capital. There's a lot of factors. It's not always obvious in the beginning, but if those things persist, you definitely, you generally can see the trend playing out.
So, Wayne, when you're building your portfolio, I mean, do you have to choose between the two of them? Do you have to get your blend right between your quality investments and your value investments?
Look, ultimately, I agree with Grant 100%. the majority of your portfolio must be quality company shares. It makes you sleep better at night time, and most importantly, it makes your clients sleep better at night time. Just one little side comment. People think investment is about finding winners. It's actually wrong. Investment is about avoiding disasters and catastrophes. That's the true key to investment. But just to come back to your question, majority of your portfolio in quality and well diversified within quality, not just 3 or 4 shares. You have quite a few shares. And then if you're really lucky, because the longer I am investments, the more I think it's luck than anything else, you can maybe perceive the turning up of the value cycle and the consequently turning down of relative performance of your quality cycle and quality stroke growth, because quality and growth are more or less in the same pocket. The turn down of the one and the turn up of the other, and then you tilt your portfolio a little bit towards value. You maybe, instead of having 80% of your shares in quality shares, you drop it back to 70 or 60 and you put a bit more into value. But calling that cycle, as I said, I think it's more luck than skill.
And Grant, what do you check before buying the share? You've got to ask why the business is, why it's for sale. What are you going to get from it?
Yeah, when it comes to value, certainly you need to ask, how am I going to realize this value? And the other point I wanted to make, Stephen, is a lot of money is made when a company's quality improves and it goes through a re-rating to the upside, and it may transform from a value company into a quality company. There's a great opportunity there. And conversely, when a company's quality deteriorates, because it traditionally has traded at a premium, you can also start to lose a lot of money. So it goes back to the comment we were making about you do need to pay attention to your quality indicators and are they being sustained. That really is important. And then I think when it comes to value, it's either a cycle or it's something management is doing, or it's a change in the business fundamentals that you're looking for. PPC was a good example. They had an absolute disaster in Africa, overextended, over-indebted. They reshaped, restructured, cleaned up that business. And if you came in at the latter stages when the value was, when it was in the low 1s and 2s, I think, there's been a great return there. But you had to have got your timing right with regard to that turnaround strategy.
Grant Nader, thanks so much. Wayne McCurry, good to talk to you again. Grant is, of course, a portfolio manager at Benguela Global Fund Managers, and Wayne, as you know, has been in the game longer than most of us. Gentlemen, really do appreciate your time on The Money Show. Thank you.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, turning intent into execution. That's how Absa are invested in Africa's energy future.
Well, in the US, things are a little mixed now. Oil prices are a little lower today. Also, of course, looking at PPE in the US, the Dow Jones is down 0.08. The Nasdaq is up 0.76. The S&P 500 is up 0.54% at the moment. Friday tomorrow, we'll have Friday File. Of course, we'll have an explainer for you as well. We'll make sure that we keep you abreast with what's going on in the world as well. Lots to look forward to. We'll see you then. Good evening. It's 8